Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening in, tuning in each and every week. We bring you information concerning mortgages, mortgage rates, what it's going to cost you, how do you qualify, what are the new and innovative products that are out there in the marketplace that you might be able to take advantage of. How can you get a mortgage if you've had some work-related issues due to COVID? All of these are questions that need answers, and obviously that's what we try to do each and every week. I'm Jeff Barton, and thanks very much for tuning in. We can be seen on YouTube. If you go to YouTube, Jeff Barton, the Mortgage Voice, that's our channel. We do a weekly radio show on 5 stations, which we record for YouTube as well. Those 5 stations are from Albuquerque, New Mexico, all the way up to Las Vegas, Nevada, up to the Reno area, up in Tahoe country. What are the call numbers for that great station up there, Daryl?
That would be KTHO, Tahoe.
And the numbers on the dial?
AM 590 and FM 96.1.
Excellent. So if you're up in the Tahoe area, please tune us in. We really enjoy those times that we do hear from people. Obviously, our wheelhouse in Southern California, in the Inland Empire, is KCAA and KMET, those great stations that have been having our show on air for, 6 or 7 years, maybe even longer. We have hundreds of shows in our archive, and we always deal with what's going on right now. So thank you very much. We're on 8 different podcasts. Daryl, you got the list of those podcasts for us, please?
I sure do, Jeff. It's
Great.
podclips.io, YouTube, radio.com, iHeartMedia, Stitcher, Spreaker, Spotify, Google Music Play, and Apple Podcast.
Excellent. Yes, all of those things you can get to us. Leave comments. Join up in what we're trying to do. It helps other people find us and to get the information. The information is not given out freely by most people. There are a number of websites that you can research, but if you're just driving around and you want to hear what we have to say, go to the radio stations, of course, or those iPods. And if you want to see us, of course, come on over to YouTube. Let's get right to some of the rates that are out there. I know if you're driving and you're listening and you're thinking about getting a mortgage or you're thinking about refinance, but you've heard a lot of talk about the rates and how the rates have increased. There's a couple of questions you're going to ask. How high are they and why are they going up? Well, the how high are they are these. 30-year fixed rate is at 3.37. The 15-year fixed rate is at 2.82. And the FHA loan is at 2.85. Jumbo product at 3.33. And of course, the 5/1 ARM is at 2.75. The 10-year yield, which we always look to see what's happening in the demand in the product, is at 1.72. Now, if you're thinking historically, these are still pretty low. But if you're thinking in the last 2 or 3 months, the rates have gone up almost 3/4 of a point, especially on the 30-year fixed. Why is that happening? Well, it's happening for a number of different reasons. The main reason, of course, is the economy is recovering. People who put their money into treasuries are now looking for other investments to be able to get a higher yield than the 0.53 or half a point that they were getting as little as 5-6 months ago. Well, now the yield that you're going to get on a treasury in order to compete with those other investments that you could put your money is at 1.72. This, of course, is on the 10-year bond. So if you're out there and you're one of these people who are just constantly following the bond market and you're talking about how you can take advantage of that, the way to take advantage of it is obviously look down the road when bonds are going to be even more, the yield is going to be higher. Now, when the yield is higher, that's good for an investment, especially now since the cost of those bonds is actually lower. When we sell bonds, we sell them in certain bundles. Those bundles are sold to the general public through investment houses and large institutional funds, hedge funds, and certainly sovereign funds. Those particular investments that you have with these different companies, whether it's your life insurance company or whether it's your brokerage company, that if you have stocks and bonds, they're the ones who are dictating supply and demand. And as I said, because the supply and demand is what it is, those companies are looking for the best return. Now, obviously, when COVID first hit, what we had was a unknown, right? We had 20 million people in the US, maybe 40, 50 million people, maybe even more worldwide out of work. So the governments had to step in and do a stimulus. And at the time, I think it was 1.2 or 1.3 trillion dollars in order to keep people in their homes and to keep people with money in their pockets in order to be able to live. Well, that wasn't an investment environment. So the flight to treasuries was what happened. And that's why the yield, the government didn't have to give anything in order to have people want to buy the treasuries, because that was the safest place to put your money. As everyone knows, the treasuries in the US are one of the safest investments in the world, never defaulted on these treasury bonds. But as the economy has recovered, and it has recovered in many different ways, in the real estate sector, which I will talk about either in this section or the next section of the show, what we did see was the real estate investment community really boomed. So that particular part of the economy didn't suffer at all, and it did just the opposite. But for those people who have fixed incomes and who need investment for their 401ks or whatever else they have the retirement savings in, for those companies that house all that, they had to put it into a safe haven, and thus we had a low yield. But the cost of those bonds were also high. Today, we have the opposite. We have a higher yield, but the cost of the bonds are actually lower. So if you're paying less than $100 per bond, and of course they sell in 100 bond increments, you are actually paying less than the bond is worth, getting more of a yield of the 10-year. Now, this is not good for treasuries, but because they have to compete now with where that money is going, investment-wise, where would you put your money? Would you put it in the stock market? I don't know, but I can tell you the stock market itself has hit all-time record highs in the last week, and it's because the economy is coming out of the COVID coma that it's been in. And why is it coming out of the COVID coma? Because of the vaccines. Daryl and I were talking off air about the vaccines themselves, when you're getting them. And Daryl and I are similar in age. We're of an age whereby we were one of the first to get it. And but they're now lowering it in most states. There's a half dozen states, maybe to a dozen states that are actually opening up the vaccines for everybody. Now, this means that people are getting to be optimistic about what's going to happen this summer. What is going to happen this summer is that many things will open up. We'll be in the summertime. Most people will be outside most of the time if they have kids or they're traveling. The traveling will have picked up because, again, the airlines have figured out that when travel picks up, people will get back to the air and want to go places. They will keep the mask mandate in place, but they will enable people to get back to traveling. All of this means that people will be spending money. And the kicker in all this is that during the pandemic itself, Americans saved $1.5 trillion. The question is, will they keep it in their savings or will they spend it? And because now they have an ability to go out and go to a restaurant, go to movies, travel, be able to go to the theme parks without restriction. My guess is we will see a much more aggressive way by which the consumer will spend. That, the $1.9 trillion stimulus package, and also we will also see additional stimulus probably come down in the form of an infrastructure bill. All of these are supported by both Democrats and Republicans to some extent. And in the Senate, we only need 10 additional senators to vote in order to make sure that it is filibuster proof in order to pass the next set of stimulus. This is all on the horizon, which is why, again, mortgage interest rates are going up. We talk about the economy at large, mainly because it affects what treasuries are selling for, and those treasuries going up in terms of the cost and in terms of the yield means that the mortgage interest rate is also going up. And as I said, it's still low now, but it's not going to stay low for long. I saw an article today that said 5% is possible this year. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to what we have to say about what's going on in the mortgage and real estate industries. It's going to be a busy summer and a lot of people looking for housing all over. Prices have gone up, real estate prices as well as mortgage rates. If you want to see this show, you want to hear this show, we're on a bunch of radio stations from Albuquerque up to Las Vegas, all the way up to Tahoe, and certainly in the Inland Empire, i.e. the San Bernardino Riverside area. And we love our IE. There's no question about that. And if you want to have a terrific person to do your loan, we got just the guy for you. He's George Gonzalez. He's been on the show many times, and he's our local guru to the area. George, how are you?
Jeff, I'm doing great, man. Thanks for asking. How are you?
I'm fine. Thank you very much. I'm a bit disturbed by a couple of things, trends in the market. The real estate is out of control, and mortgage interest rates are rising. What do you think is happening, and how do you think we can best serve the people that need a loan?
All right. Well, man, it's a lot going on, and I wish we had more time. But real quick, I'm going to try to cover as much as I can.
Okay.
What I'm seeing right now with my qualified buyers is a bloodbath out there. They're fighting, offers. There's 20, 30 offers per house, and it's over asking prices and ridiculous contingencies and addendums. It's pretty crazy wild out there right now.
Yeah, I agree with that 100%. And I know there's no relief in sight other than rising interest rate. Is that going to cool the market?
Oh man, I don't know. The thing about it is they're creeping up just like the stock market's doing. They'll shoot up and then come back down and then balance back up to level off a little bit just to bring a new low, you know what I mean, a new bottom.
Yep.
And so, yeah, the rates are creeping up a little. It's bringing your buying power down for some buyers, but I haven't seen it slow down yet. And I don't know. I don't know what's going on. I'm just a bystander right here trying to make it happen.
Well, that you say that, I hear what you're saying. I think that what we had was a refi market that was so strong. It was really dominating the industry. We're now backing off that because rates went up. I mean, we went from 18 million people who could benefit from getting a refi down to 10 million people. So that means 8 million people missed out on the low interest rates, like they should have gotten in on it. But I don't know if that translates into lower real estate prices because fewer people can afford purchase, because purchase has not slowed down at all.
No, the purchases are still on a rapid rise. The prices of houses are becoming insane again, and a lot of people are asking, "Hey, George, is it looking like 2008? Are we're going to crash? The market's going to crash? Should we wait and this and that?" And I'm like, I don't know. I wish I knew because I'd be a rich man if I knew. But no, actually, I just tell people I just go day by day, and the qualifying purposes are still hard. They're still difficult to get qualified. So it's not like '08 in the qualifying process. But as far as values increasing, that's happening pretty rapid.
Yeah. Have you seen any difference in how appraisals are done? Are they harder? Are they harder on the price? Are they looking at more than just 3 comps? Are they looking at other factors?
Well, I know one thing for sure is the strange factor is they're not doing complete appraisals due to the pandemic that's still going on, the madness of that as well. And so, I don't know how they're coming up, but a lot of the appraisals that I'm getting back on my purchases are coming back a little bit shorter than what the accepted offers are being offered,
Right.
but they're paying different. They're having them sign the addendum saying that they're going to pay the 20 or 30,000 over the price that it comes over the.
Well, to me, that's just genuinely not fair. You know what I mean? I mean, you agreed, obviously, a price, and if the appraisal comes in over that, you agree to pay that too. So it's worth it for the seller to hold out for the highest price because the appraisal might come in even higher. Or if it comes in low, you got to pay the difference.
Situation for the buyers. I hate to say it because I'm in the business and I'm a
Yeah.
buyer's advocate. But you know, it is what it is. You know, it's out
Yep.
there, and only I can do is I can be transparent with these buyers that I'm qualified, and just being real with them is what I call it. And I let them know that, you know, hey, you might have to pay more than what the house is worth. So
Right.
you might want to think twice about, you know, fighting for this house that you want.
Right. No, I tend to agree with that. George, shout out your phone number for somebody who needs a terrific loan officer out in the IE.
909-900-9565.
Excellent. Thank you very much, George, for coming on the show. Really appreciate your update and also your insight as to what's going on. Thanks a lot.
Thanks, Jeff.
Okay, I'm Jeff Barton, your voice in the mortgage industry, and that was George Gonzalez. He's a loan officer at Malibu Funding, 79620. Thanks very much. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Thanks very much for listening each and every week. Try to understand what's going on in the mortgage market, what's going on in the real estate market. How can you take advantage of whatever is going on? And the person who could take advantage of this particular market would be somebody who has a house that's almost completed because they could sell it 9 times out of 10 to the highest bidder. I mean, the real estate market is crazy. So if you're out there and you're wondering why, and you're trying to figure out what's the best course of action for you, you're not alone. Anyway, we are also on a number of different stations. We're on podcasts. Daryl, you have those 8 podcasts handy for us? Or 9?
I sure do, Jeff. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
If you go to podclips.io, they have a great financial section there. I'm in. This particular show is there, plus a number of other ones. It's a great source and a resource that you can, again, research what you're trying to do in a number of different areas, but that's one of them. We're also on YouTube, Jeff Barton, the Mortgage Voice. That's my mortgage channel. You can see this as well as hundreds of other shows talk about what's been happening on those particular days. We do a 1 to 5 minute show on LinkedIn and Facebook every week as well. And certainly we're on a bunch of other stuff that I can't remember right now. But to remember for me, somebody who has been in the real estate and mortgage market for a good time, has seen some ups and downs. Jennifer Conrad joins us as a loan officer for Malibu Funding. Jennifer, how are you?
I'm doing well, Jeff. Thank you so much for having me.
Thank you very much for coming on the show. Give us your perspective as to what's happening with mortgage rates.
Actually, the rates are still really, really good. I have noticed that we have a few lenders who are sort of implementing what we call a half a point charge on each loan they're saying because of market conditions. But even with that being considered, the rates are still pretty competitive. I mean, you can still get a 30-year fixed rate on a conforming loan, low 3s, and for FHA loans, you can actually get it in the high 2s. So those are still available.
Yeah, I think that it's true. I think when people see rising interest rates, they get a little bit nervous. I do know that some of the people who could have taken advantage when rates were absolutely at their rock bottom can't anymore, and they've missed out on the boat. But there's still millions of people who can do refis, and certainly on the purchase side, your purchasing power stretches pretty far at 3.5%.
It does. It doesn't. I noticed that with some of the lenders, they're bringing back some of the things that we used to have before, that they had stopped, like being able to submitting a loan where we can actually get a borrower approved on a to-be-determined property. And that actually works out for people, because maybe in some cases they want to know, before they actually are out looking for homes, that they have a solid commitment from a lender to do their loans. So we do have a couple of lenders who are back in the market of doing that. And then there are so many other programs that are also available to people who are looking to purchase as investors, not necessarily with having to put down 25% anymore, but actually 20%. And in that case, we basically are going to go off the rent that you're collecting from this home and your assets. Basically, what's considered a NONI program. So we have some programs available like that have sort of come back out. And recently I noticed that I've had a couple of borrowers who were in a situation where maybe they were W-2'd, and in light of a lot of things happening with COVID, maybe the lenders are not, their current employer is no longer having them on payroll as a W-2 employee, and so they're sort of working contract. Well, we have a few lenders that say, if you're in that kind of situation, we can take your deposit for the past 3 months and still allow you to qualify with a pretty competitive rate to be able to do a purchase or refinance. So there are a lot more programs that are coming available.
I like the fact that you bring that up, because those particular programs are not rate sensitive, as if you were getting a 30-year fixed rate W-2, 20% down type of loan. It's just not.
Right.
I had a call today from a hard money lender who said, I called you 2 years ago. And I said, great, send me an updated rate list. And she said, well, we really haven't changed rates in 2 years. I'm like, okay, well, that tells you something.
I think that with those particular programs, a lot of times, when we have borrowers who either need a quick patch, maybe you're trying to get into a house, or you're trying to purchase a property investment, and so, you're under a time crunch, you might need to be able to get in, but at least it allows you to get in and not have to, basically break the bank. As far as the down payment, maybe the rate is not always the most competitive, but I am finding that even like with the 3-month bank statement program, we're looking at rates, 5.65, and even with the NONI program, where I was talking about, 20% down, and we're going off of the rent of the property, it's still 5.75, which is still pretty good for that type of program.
No, I agree with you 100%. My first loan was 8.75%, and I was happy to get it. And that wasn't even all that long ago, 25 years. What? It wasn't like the Carter years when they were 18 to 20%, but it was still high. If you're going to get it's not off-brand, but certainly if you have some issue, or there's the credit issue, or you just have to go by bank statements or such, a 5.5%, 5.25%, or 5.75% is still very, very good.
And it's still a 30-year fixed program. So, and like I said, with some of the people, definitely, it may not actually be even an issue with anything other than the fact that we're doing, a debt service loan where it's just a lot easier if you're qualifying just off of the rent of that property, and then you have assets, so that at least opens it up, for people to be able to purchase, especially if they are wanting to get into like the investment side of owning property and starting their portfolio. It gives them a foot in the door.
No, I agree. Now, you do loans in Florida, you do loans in Illinois, certainly here in California and a number of other places. You see any difference in how property is selling in other areas other than Southern California? The reason I ask is just because we have a lot of listeners that come to us from different places, and obviously Southern California prices do not exist other places. What are you seeing out there?
I am seeing the market is starting to pick up, like in Illinois. Originally I came from Illinois before being out here in California. So with the weather starting to change, it looks like people are more interested in getting out and actually, looking for property. And of course, Florida is a lot like California. People are sort of, getting involved and buying property year round, although we still have a good amount of investors, foreign investors who are wanting to purchase in the United States, and that honestly did not seem to be affected quite as much by COVID. It seemed like people were still, wanting to invest, but there was more concessions made for people to be able to maybe go to an embassy in their country and sign and close versus having borrowers actually fly to the U.S. to be able to close on their loan.
That's interesting. I was wondering about that, wondering if, because we do a number of loans down in the Florida market, Brazilian buyers, and I was wondering if those loans had dried up just simply because COVID, you couldn't travel.
No. We had some lenders that were actually not doing the loans as much, and they laid off quite a few of the account executives. But we've had one particular company that we do a lot of work with, and so they sort of remain the same. It happens to also be the same company I was talking about with the 3-month bank statement program. So that has always remained. It was just, like I said, a matter of having so many more lenders that were offering it, and then to kind of downsize to about 2 lenders that actually were still in the market. So, but then the business for that is definitely still there. And actually, Jeff, you know what? We also have another program that has resurfaced, but this one is actually better than it used to be, and that is for our I-10 borrowers.
Okay.
So that allows our borrowers, to be able to put 10% down and to be able to purchase. And in some cases, people are waiting to get, an updated Social Security number in. But while they're having their I-10, they're able to go ahead and purchase with 10% down.
Excellent. Jennifer, shout out your phone number for somebody who wants a terrific loan officer in a number of these different markets.
My number is 773-593-6831.
Excellent. Jennifer, thank you very much for coming on the show. Appreciate the information, and we'll do it again.
Thank you so much for having me back.
Always. This is Jennifer Conrad for Malibu Funding, NMLS 79620. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for tuning in, for listening to the show. Really appreciate it. We would love feedback. If you go to either the website, or you go to YouTube, or you go to any of these podcasts that we're on, radio stations, whatever you see, leave a comment, join up, get involved. The reason I say that is because what you have a question about is probably 50,000 people listening to the show who have the same question, who just didn't do what I'm asking you to do. So please sign up, ring the bell, do whatever you can to try to pass the word around. The mortgage information, the mortgage market, it is constantly changing. It is not simple. And if you rely upon your mortgage loan officer or somebody at the bank to educate you while they're trying to sell you something, it's probably the bad idea. So more information is best for you. And again, we're on 5 radio stations from Albuquerque all the way up to Las Vegas to Lake Tahoe. We're in the Inland Empire in Southern California. 8 different podcasts as opposed to 100 different podcasts, but we're on the major 8, the big 8. And so if you're out there and you're listening to them, that's great. YouTube, go to YouTube, Jeff Barton, the Mortgage Voice. And we're on LinkedIn and Facebook on a daily. And you can see our show. If you want to be included and you want to join my Facebook page, or you want to join my particular LinkedIn page, just go to any of these sources that I have just mentioned and leave a note, and we will include you and get you signed up. LinkedIn, you can do it immediately, and certainly with Facebook, you can make that request. Okay, so a couple of things that I wanted to get to in this segment. One of the things was when you're a company or when you're an individual, and anybody who has grandparents or anybody who has older relatives or older friends know that during the pandemic, they have been called numerous times by people who are trying to get money from them. Either it's the call from the Social Security Administration telling you that you need to call immediately to verify your information or you're going to lose your benefits. Or you're calling from the power company, whether it's Edison or whatever, whoever it is, saying that unless you pay within the next 30 minutes, they're going to shut your power off. Well, these people exist and they're out there and they're trying to get you to give them your money. Now, if you're older, if you're have older friends or relatives who have had this happen to them, you know what a pain it is, especially if they end up giving you money. Well, there are a number of ways by which other companies, in a legal way, can try to get money from you. I am involved in one right now. If you own a website, this is something that you must listen to. This has been going on since 2017, and at its heart is the moral obligation and the moral argument of being able to help those who can't help themselves. Used properly, it's a terrific tool by which to take money from your pocket and put it in theirs in a legal fashion. If you're in a state which has passed ADA compliance website legislation, you know what I'm talking about. Since 2017, there has been a 200% increase in the number of claims through lawsuits against companies who are not ADA compliant. What is ADA? The American Disabilities Act, which is a terrific tool by which we can make sure that the sidewalks are wheelchair compliant, that buildings have elevators, that all of the things that are accessible to abled people are also accessible to disabled people. And it's terrific legislation. However, that's the national ADA. State by state, they do their own. In California, for instance, they passed back in, I believe, 2015, a law through the ADA which required that blind people can surf the web as much as anybody else can, and you have to have your website to be able to be searched by someone who can't see. Now, in my particular case, I have a number of websites. One of the websites I have, and you may have this too, it's a brochure website. There's very few pages, and it's meant as basically an augmentation of my either real estate or my mortgage license. It's a brochure site that shows people who come to it, who you are and what you are. And most of these websites built between 2012 and 2017 are not current ADA compliant. I am one of these people, and one of these people who have been contacted by an attorney through a complaint from a nonprofit in Florida, subbed out to 3 attorneys here in California to be able to make those sites that aren't, make them that they are compliant with being able to be seen, i.e. Looked at or searched from someone who is blind or deaf. In both of these cases, it's a matter of fixing the website, which most people will do. Why? Because it's the moral correct thing to do. However, there's a thing in the law in a state like California, and I will quote California because that's where this particular incident is happening. They wish to get reimbursed for their legal expenses. Okay? Now, therein lies the issue. Having received an email and a phone call, I was told that the legal expenses was $7,500 for this particular law firm. And I found that to be exorbitant, and I found that to be excessive, and I told them so. And they put pencil to paper and dropped the price by $600 whopping dollars to now it's $6,900. Now, I don't know anybody out there who watches television. There's a show called Bill Maher, and he does whatever his show's called. Do you know what his show's called, Daryl?
Not the recent shows.
Okay, so whatever his show is called, he has a solar meter, meaning that he has been waiting 1,100 days to get solar. He still can't get it. They're involving everybody and their brother to try to get approval to put these panels on his roof. Okay, well, it's like that with this situation with ADA compliance, which I'm 100% for. If the website isn't done right, I'll fix it. What I immediately did, I called an independent company to do their own audit and then fix whatever the problem is. It's going to cost me $3,000. Okay, that is their fee to fix the website, which I'm going to do. But paying a law firm to make a phone call and a email, $6,900. So I asked for an accounting. And of course, they had all, in typical lawyer fashion, they had drafting of the document. They had a review of the drafting of the document. They had a confirmation of the review of the drafting of the document. Then they had a review of the response of the drafting of the confirmation of the document. And these are all legitimate fees on their bill. We up, Daryl? We good?
Bill Maher's program is politically incorrect.
Okay, politically incorrect. Thank you very much. I appreciate that. So what I'm saying is, like people who get, your older people who come after, the people who say, yeah, your power is getting shut off, you owe us $50 in the next 10 minutes. Or, hey, this is the Social Security Administration, please give me all your information so we can verify who you are. All of these type of people, they're just lousy thieves. These particular people have come after companies, and as I said, did I say 200%? 2,000%. That's how many of these particular lawsuits or claims against companies with websites built between 2012 and 2017. So that's how I got caught up in this thing. It's going to end up costing me $5,000. And here's the thing, when you start to enter into negotiations, you admit your fault. So part of the tact is to not admit fault. Yeah, I'll fix it. It's like if you have a faulty muffler and you're spewing smoke into the air and you get pulled over and cited, yeah, okay, I'll go fix it. And they basically give you a fix-it ticket. If you fix it, you don't owe us any money. That's what this should be, as opposed to the predatory practices done against innocent consumers who are just trying to promote their business, make sure that people get employed. But again, it's used under the moral justification of the ADA, which is a great law. It's helped a lot of people, and I'm all for it. But you can't use that as a hammer to collect money for fees which are driven by whatever's happening within the law firm. They're not actual costs. Typing up an email doesn't cost you $1,000, $1,500. Anyway, that's my complaint to the day. And if it's happening to you, I totally empathize. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. We have a great show and have had a great show so far today. We bring great guests to the show all the time. We talk about what's going on in the markets, whether it's in real estate, whether it's in loans, both here in Southern California where we produce the show, and all the other states, obviously, that are able to listen because it's the internet. We're trying to reach as many people as possible. And if it's possible, go to our site, themortgagevoice.com, go to Jeff Barton, The Mortgage Voice on YouTube, and sign up, become a member. The more people do that, the more people can get the information about the show. And that's very helpful if you're out there and you really don't know a lot. We try to be friendly with the information. We try to explain a lot of stuff. I know to some people, to the sophisticated investor, this may be rudimentary, but it's always good for somebody who does not know to know. We are producing a number of how-to videos, how to fill out a loan map, how to figure out which is the best loan product for you. Going in forewarned is forearmed when you're talking to potential real estate or potential loan officers, or to go into the bank to be able to find out what is the best product for you, the best thing to do is to listen to shows like this, because we bring on those people from lenders all over the country to be able to explain exactly what is a bank statement loan, what is a no doc or a low doc loan, what is I have a terrible credit score, how can I get a loan? What do I have to do to qualify for these types of products? And how do I begin to help the loan officer by filling out the application, or what kind of documentation you need? All of these are in the how-to videos that we're doing, and those can be seen both in Spanish and in English on our the YouTube channel, Jeff Barton, the Mortgage Voice. Talking earlier in the show about the economy and how interest rates are affected by the economy overall, and the perception. Interest rates are really a perception of what's going on now and in the future. In what has gone on in the past are all the economic indicators, and we constantly see following economic news. The stock market itself looks forward into the future, and when you see rising stock prices, but also rising interest rates, they kind of go hand in hand in this particular economy. I want to get to a couple other things here. Today, mortgage rates have gone up. The trend is up. Rates and home prices, right? So what is the effect on home prices if rates go up? There's a couple of different schools of thought on that. As everyone knows, all over the country, and I'm currently in a city of Portland, Oregon. Just to give you an example, up here, the cost of houses has gone up by 10% from this time last year. Well, actually, this January last year. We really can't go to last year, COVID. We have to go prior to COVID to really get an honest assessment of where real estate prices is. But as I have said earlier in the show, real estate prices have boomed this year. The product has boomed. It's because of the low interest rates. Well, interest rates have risen, so now we have rates going up, and what is happening to home prices? Well, home prices themselves are also going up. So if you're in the market to buy a home, you're going to have to pay more. How does that mean in the future? What's going to happen in the future in a city like Portland? Over the weekend, I was in Seattle. Seattle went up 12.5% last year, January to January. Home prices, now these kind of home price increases are really high, and nobody can have those sustainable prices if in fact we have first-time home buyers, millennials, others who want to get into the housing market. And we talk about housing as the way by which you have to get into the U.S. economy through the purchase of a home in order to really reap the benefits of long-term increase and wealth to your family. It has to be through real estate, unless you're a tremendous person who can invest either in the stock market or other investments out there. But real estate has always been and will always be the way by which we in the U.S. can invest and expect our returns to go up. When I was a kid, I've said it before, housing, when you bought a house, you were lucky to get your money out, which is why nobody ever sold when they just gave it to their kids, and that was the way by which they could pass on wealth. Well, this phenomenon of prices going up, or this phenomenon of increasing equity in your home, has only been a recent phenomenon, let's say in the last 35, 40 years, well, since this maybe 50 years. And as a result of that, we have things like cash out refis. Do you qualify for a cash out refi? The interesting thing is most people do. The reason is because let's say you bought a house 4 years ago and we've seen double-digit increases. Let's say it's gone up 25%. That means that you now have, if you bought the house with 10% down, you now have 35% in. Well, you could probably take 15, 20% out of your house in cash, maintain the same rate you got 4 years ago, because at that time it was about what it is today. It actually was higher. It was 4.5%. 30-year fixed rate today is 3.75, as you know. So this is a phenomenon that keeps the economy juiced. There's a lot of money out there in the economy. There will be a lot of stimulus money in the economy. People are worried about inflation. They're worried about, if the money is going to be worth what it is today, tomorrow, if we're going to see rising prices all across the board, and that's not good. But from what we understand, core inflation whatever core inflation is. And of course, I know what it is, but if you're out there thinking, what the heck is core inflation? The inflation rate will remain around 2%, maybe a little above, maybe a little below. The Fed has talked about keeping inflation above 2% for a while so that we can catch it. Most of that is about wages, right? We want to see people back to work. We want to see people making more money. And the thing about when we talk about rates and home prices, all of this affects what is the demand on housing. Now, we know, we talked about it, there isn't enough housing in the US. There hasn't been enough housing in the US since what they're calling the Great Recession 2008. They're just not building, have not been building. Prior to that, 3, 4, 5, and 6, 05, 04, 05, 06, we had just tremendous building in, let's just talk out west, Phoenix, Arizona, Las Vegas, Nevada, certainly huge building, like so much so that they were building because they anticipated huge population growth. Well, population died, growth died, even though it's picked up today, 10 years later, 12 years later, at the time, because the economy died. So construction jobs went down, service jobs went down. A lot of things in the real estate market collapsed. Prices were down by, in some areas in Las Vegas, for instance, by 2/3. Well, today is not that. We don't see that on the horizon. What we see is demand, pent up demand, and now an economy coming back fueled by what's going on with the stimulus package. So we're going to see a lot more people coming back to work. Now, the inflation that they talked about, that I talk about as mostly in labor, has to do with, well, when all of this money gets infused into the economy and people get hiring, the cost of hiring someone is going to go up because there's going to be a lot of companies looking for more people. My company, who is Malibu Funding, sponsors the show. Thank you very much to those people. Their demand on new people to hire has gone up. So you're going to have to pay those new workers more in order to make sure that you get the qualified individual that you want to hire. And you're going to have to increase wages on your current employees because those people are high in demand as well. So all of this adds to the inflation of what things will cost. And therefore, the cost gets borne by people who are your customers. Those rates are going up. And the margin by which you borrow the money from in order to lend it out is going to get greater. This is the relationship between home prices and rates beyond what is the treasuries and where they sell their treasuries to, and the demand on those dollars from other sources. So all of these things combined means that, yeah, we're going to have a great summer, but cost of housing and cost of rates are going to go up. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.